I There we go. Okay. All right. Well, I just want to introduce Walt. Thank you, Grizzly Adams, for I'm just I'm just teasing you. I'm Tracy with Fidelity. I just want to thank Walt again for always bringing us some awesome content. It is December, and obviously the market's getting a little slow, so it's a great time to ramp up our education and our social media and our marketing and get it squared away for next year. So I want to remind people, I think they kind of forget that we have Breakthrough Broker. I've been meeting with some agents lately on, they want to ramp up their social media, and there's some amazing tools in Breakthrough Broker. If you guys don't have that, just reach out to me and I'll get you set up. But it's just a really good time to get in and work on perfecting our craft while we have a little extra time right now. So, and with that, I'm going to let Walt educate us.
Perfect. Thank you. So, yeah, if I was in a class yesterday, and it was very interesting, the information that was shared. It was actually, we did a class last month where I flew Deb out, who's the CEO of Plug and Play SM, who is my social media expert.
And she's amazing.
She's awesome.
Yeah, so you guys should be following her on social if you can.
Yep. And I was on a conference call with her sister, who is a top producing loan officer in the nation. And her sister had some very interesting statistics that she shared with. And that was that it's really that the generation that is from 1997 to 2000, they were born in 1997 to 2012. I forget what they're called. But that generation, they don't check their emails. And so
those are my kids. And I know they hate social media. They don't check their emails. They don't reply to text messages.
Yeah.
They're
And
little jerks.
that's the one where, and I just had this happen. I mean, literally, I just had this happen with a client. It was very interesting because as I heard about this, they will typically not talk to mom and dad about buying a house yet. They will research on social media. And remember, these kids were kids that, I mean, they were almost born with a smartphone in their hand.
Mm-hmm.
So
and they hate it.
Everything, yeah, I mean, everything, but it's how they get information. And what was very interesting to me and just very thought-provoking to me was they will search your social media platform and see what you have out there. They'll search YouTube to see if you have anything on YouTube. They'll search your reviews, Google reviews and other reviews. They will search those before they'll ever talk to their friends. They then will start to talk to their friends through social media in their various platforms that they use. And then from there, then they'll talk to mom and dad. So the realtors that are relying upon mom and dad to bring the referral of their kids, a lot of times it's already too late.
Interesting. Yeah.
So
I can imagine that that's probably true.
Yeah. I mean, not only do you need to be working with mom and dad with your client database, right, in your sphere, you need to be helping them, but then you need to make sure that you have a strong social media platform. And that means video. That means, print. I mean, there's so much to that. And so yeah, so it's been, to really watch that has been really mind-boggling to me. So
yeah,
anyway.
Cool. Okay, little sidebar.
So you've got tools there for social media. So talk to Tracy.
Yes.
Media. If you need escrows, Fidelity's awesome. Talk to Tracy. She'll get you keyed up with the right escrow officers. And that I've used Fidelity now for, I can't tell you how many years. Love Fidelity. They always come through, always take care of our clients. So I can't endorse Fidelity enough. So thank you, Tracy.
Thank you. Thanks, Walt. Cool.
All right, guys. Well, so we are going to get rolling here now. I ended up, let me share my screen here. I ended up, before I do that, let me just talk to you. yesterday I redid my whole presentation. And I really started thinking about what market we're in, what are the challenges that I'm having. I reached out to a few different realtors and found out the challenges that they're having. And it seems to me, correct me if I'm wrong, but most of the challenges that we're having are getting clients off the fence. We're starting to have more and more clients that are saying, now I'm going to wait until interest rates go down. Now, what I've done is I have a presentation I go through with the client, and it gives them statistical data that they cannot deny, that when they ponder about it, will get them off the fence. And I'm going to share that presentation with you today. This is exactly how I get clients off the fence. We're really good at getting clients off the fence and getting them ready to buy, because I believe right now, this is literally the perfect storm and the perfect time to buy. I don't think you can find a more perfect time. The only other perfect time to buy, since I've been in the industry, and as I'm looking at the attendee list, there's a few of you that have been in the industry longer. Only a few though. But I think that the only other time that was the best time to buy was in 2008. And we can always look back to those times and see, oh, I wish I would have, I should have, I could have, and that. And so for whatever reason, I have really started working over the last 6 months on getting clients off the fence and doing it with statistical data that they cannot deny. So I'm going to share that with you today. We're going to cover everything that we talked about through the process. And so, but I wanted to share with you exactly the process that we go through and how we get clients off the fence. So should I buy a home right now? Really the first area that clients start to talk about is inflation. And that's exactly where I lead them to. I'm going to ask a client, what is inflation? And of course, you guys can see the slides over on the left-hand side, but ponder in your mind, what is inflation? Most people cannot answer what inflation is. They just know what the feeling is. Inflation hurts. The average family right now is spending over $500 a month just to live. And that's just to live. That's with the goods and services that right now are costing more. I mean, shoot, those that know me know that I drink too much soda. I like soda. That's my vice. And it's bad for me. Yes, I know that. And so, but I drink too much soda. And I mean, crud, I'm over at Panera the other day getting a bagel and getting a soda. And the soda was $4.29. I'm like, holy cow, I'm not buying soda there again. But anyway, goods and services cost more. Now, when we look at what is the definition of inflation, it is a decline in buying power of currency over time. What does that mean? It's kind of like the rule of 72. The rule of 72, when you're looking at investing, what does that mean? So I've dumbed it down for myself to where I can understand it better, because I really don't understand a decline in the buying power of currency over time. I understand what that means, but it's hard for me to really articulate that. However, what I tell clients is it is the exact opposite of the laws of supply and demand. It is too much money in the market chasing too few of goods. That's really what inflation is. Too much money in the market chasing too few of goods. So if you look back at the laws of supply and demand, we lived the laws of supply and demand just not too long ago with housing. And, we had much more demand than we had supply. Hence, a lot of our clients had to pay $10,000, $20,000, $50,000 over asking. But we had clients that offered $70,000+, $80,000+ over asking and didn't get the house. So we are going back to that market. That's why I say this is the perfect storm, I think, right now, to purchase a home. And we don't have very long to get our clients in a house before that market starts to come back. And I'll prove that to you. So again, what is inflation? It is the exact opposite of the laws of supply and demand. It is really that there is too much money in the market. So who put all that money in the market? We're going to talk about. And it's chasing too few of goods. Let's talk about inflation as we look at it from 1955. Inflation has been relatively tame, with the exception through 1970, through the 70s and the 80s, which we all know about. We all hear about the horror stories, but it's been relatively tame up through 2020, with the exception of the last year and a half or so. Now, as we look at actual inflation numbers, you can see again, we're right in the Fed's area where they want to be, which is really about 2%, 2 to 2.5% is their really goal for where they want to see inflation. And we were there, in that 2.5% range, all the way up through April of 2021, where inflation started to top out a little bit. Now, what's very interesting about that is that the Fed kept saying at this time, as the inflation numbers kept coming through, that inflation was transitory, that it was not prevalent in the market, that it was transitory. We had the Secretary of the Treasury, Janet Yellen, who used to be the head of the Federal Reserve, who used to watch our monetary policy. And she said that we don't need to worry about our national debt in 2021. Now, I don't know about you, but my debt, I have debt, doesn't just go away. I don't have to just not worry about it. I have to manage it. I have to take care of it. I have to oversee it. I have to pay it. We as a nation have to do that same thing. We don't have to just not worry about it. But here, as the Fed kept looking at they kept saying, no, it's transitory. It's going to go away. It's going to go away. All the way up until November 2021, where they started to be honest. Now, when we look at 2021 and 2022, the average inflation rate was 7% and 7.7%. So it had increased. You can see that it increased significantly over this period of time. Now we can feel that, right? We feel that in gas prices. We feel that when we go to the supermarket. I mean, shoot, it doesn't seem like I can get at. I will go to the supermarket for just a couple of things, and it's costing me, $70 by the time that I get out of the supermarket. And I know many of you have felt that same way. So that is how we feel about inflation. We feel it. We feel it in our pocketbooks. Our goods and services don't go as far. So what is really the Fed's role? I mean, the Federal Reserve, what does Powell do? And what do the other Fed chairmen do? And really, what is their role? They were created with one role in mind, and that is to kill inflation. That's their one role. They have said it multiple times in their presentations. They are there to kill inflation. Inflation is really, really bad for the housing economy. Now, in November, I said November is when they started being truthful about inflation. And you can see that's when we had the deterioration of the bond market. It was really in November. So they started saying, well, no, inflation isn't transitory in November. It actually is prevalent in the market. It's not transitory. And we're going to have a little tough road to hoe here for a little bit. And so inflation kills mortgage-backed securities. Money comes out of the bond market, goes into the stock market for a little higher yields, higher returns, because some companies are going to be a little more profitable. Some aren't, but some will. So then people pull their money out of the stock market, go to the bond market for higher yields, higher returns, which then has a deterioration on the bond market, like we've seen where we went from 3% rates a year ago to topping over 7%, 7.5% over the last couple of months. Now you can see we're starting to come back. I'm going to talk about why. Now, as we look at, again, the Fed's role is to kill inflation, and they do that through the federal funds rate. Now, again, for those of you that have heard me, this is the actual presentation I'm going through with a client. I am saying these exact things to a client. So this is exactly how I give this presentation to a client. So the Fed's role is to kill inflation. They hike the Fed funds rate to slow the economy down. As they slow the economy down, they then will push us into a recession. It always happens, period. It always happens. Every time since 1955 that the Fed has hiked the Fed funds rate, they've pushed us into a recession. These dark lines are recessions. And these lines here, as we're heading up, they're increasing the Fed funds rate. Boom, we hit a recession. What happens during a recession? Rates fall. It always happens. It is a law that happens. The other thing is that the Fed always goes too far. So every time the Fed tightens, they go too far because they're looking at lagging data. They're looking at the CPI report, the Consumer Price Index report, which is lagging, a 6-month lagging report. So they're looking at that. So they always go too far and they always cause problems. Now, and they have a tough job. I mean, I would not want to be a Fed chairman. They have a tough job. So as we look at here, this is the Fed dot matrix. This shows where the Fed believes each member of the Fed. Remember, there's more than just Chairman Powell. There's multiple members of the Fed. And so this here shows where they believe the Fed funds rate all should be. Now we're at 3.75 to 4% right now. Excuse me as I get ready to sneeze. So 3.75 to 4%. Now in 2022, they're all believing that we need to be around 4.5, 4.25, 4.25 to 4.5. But they believe that we should push up in 2023. So next year, we shouldn't pause. We should continue raising the federal funds rate to slow the economy down, and that we should be up around the 4.75 to 5% range. A good portion of them believes we should be at 5%. And then 2024, we should start coming down. 2025, we should start coming down. Pay attention to this decrease here, because this is key to what the Fed does. Remember, as they raise the Fed funds rate, they slow the economy down. So the Fed here, just from their chart, just from their dot matrix, is saying they believe that the economy is going to be slowed down in 2023. And at that point, what are they going to have to do? They're going to have to speed the economy back up. And the way they do that is by lowering the Fed funds rate. Now, what is the Fed funds rate tied to? And that's something important to know and important to be able to share with our clients. The Fed funds rate is tied to the overnight cost of funds that banks borrow money from the Fed. There's only a certain amount of banks that can borrow money from the Fed. And then the rest of the banks borrow money from those banks that can borrow money from the Fed. And that is at the federal funds rate, so 3.75. Now, when they raise the federal funds rate, they're raising that overnight cost of funds. And so the banks then have a rate called prime lending. Have you heard of prime lending? Most people have. So prime lending is 3 percentage points above the federal funds rate. That is the margin at which the banks get their money. Now, prime lending, what is tied to prime lending? And it's important for us to know this and for our clients to know this. Our credit cards, auto loans, home equity lines of credit, and personal lines of credit. So all short-term lending is tied to prime lending. Now, as they raise the federal funds rate, the banks raise prime lending, which then slows. The idea is that it's slowing people down on spending money. Now, again, as we go back, we look at, that, and let me go back to this slide here. So as they slow the economy down, at that point, they go too far to a point to where they stall the economy. When they stall the economy, they need to speed it back up. And the way in which they do that is by making money cheap. They make money cheap by lowering the Fed funds rate. So they always have to go back and they have to start to lower the Fed funds rate. They're chasing it down as inflation is going down. So here, just by this chart, the dot matrix chart, we can see they firmly believe that inflation is going to drop off pretty quick as we head into 2024 and 2025. I think it's going to be a little faster than that. But ultimately, that's what they believe. And we can see the majority of them, they're getting back down into that 2% range where they really want the Fed funds rate in that level when they want inflation. Now, as the Fed always goes too far. So this was their comments in November 3rd, 2022, when they had the most recent increase of the federal funds rate. So the Fed raked the height, or the Fed hiked the rate by 75 basis points as expected. Unanimous decision. Fed funds rate was now at 4%, so it's 3.75 to 4%. Statement adds flexibility on future increases. So the market liked that. It was ready for that. The market already had that baked in there. The committee anticipates that ongoing increases in the target range will be appropriate to obtain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time, which is where they want to get inflation to. Now, the markets had a really nice rally when this happened. The Fed makes their announcement around 11 o'clock our time. And then, I really wish they wouldn't do this. They then go and then they have a press conference afterwards. Those press conferences are really what gets us into trouble. Because at that point, they start to talk too much. And it's kind of like that salesperson that they've already closed the sale, right? And then they throw up on the table with all this other stuff that then the sale then doesn't go through. The Fed consistently does this. And so they have a press conference. Well, during that press conference, they talk about that the Fed does not feel the press conference, the media does not feel that the Fed has done too much. Slowing is coming, maybe as soon as the next meeting or after the next one. But this was really the market, that it's premature to be thinking about pausing and still have a ways to go. When the Fed talked about that it's premature to be thinking about pausing, that's where the market then sold off. So the market really looks at what the Fed says more than what they do. It's kind of like what my dad used to always say growing up: do as I say, not as I do. The market really looks at what the Fed says more than what they do. Would rather overdo it than underdo it. And this was the killer comment that they made. Can always cut rates in the future. Would rather overdo it than underdo it. Can always cut rates in the future. The Fed always goes too far. It's important to know that. At that point, the market sold off sharply. And we had a significant, let me see if I can pull that up here. I don't. You guys should still be seeing my screen. This was November the 3rd. So where are we? Right here. So the market then sold off at that point. We had gains and then the market sold off. So why is that important? It's important to know, again, the Fed goes too far. They plan on going too far. The Fed is going to raise the Fed funds rate too far. They're going to slow the economy down too much. Now, they printed a large amount of money, to be exact, $7 trillion is what they printed during COVID. We had three bailouts, what do you want to call it? We had those $2 trillion, three of them, money that went out to everybody, which was very interesting because that's when we had the highest savings rates. We had a $1 trillion bailout for the banks early on in COVID, literally in March of COVID, that nobody talks about. So they printed $7 trillion, which that's as well how they can flood the economy with cash. And if you remember, what is inflation? Too much money in the market chasing too few of goods. So the Fed flooded the market with cash and didn't raise the Fed funds rate yet. They kept it where they were up until November of last year. Well, actually, it was this year when they started raising the Fed funds rate. So we had huge savings rates during COVID, compared to where we've been since 2008, massive savings rates. But here's a problem. Right now, as of June of 2022, 23% of Americans don't have any savings at all. Just a little bit ago, we had massive savings rates. Right now, we're looking at no emergency savings for 23% of America. Less than 3 months worth of expenses, 28% of America has. Savings over 3 months, so 3 to 5 months, 22% of America has. And savings over 6 months, 27% of America has. It's also interesting to find that over 40% of our homes out there in America have no debt. So I find the large savings and no debt to be very interesting. But for the majority of us, we have less savings right now, and the majority of America is now starting to use credit cards to survive, which is a very dangerous thing. So as we look at credit card usage here, credit card usage has gone up significantly. Just 3 months ago, we were at 15% utilization for credit cards. 2 months ago, we were at 19%. And last month, we were at 21 to 22%. So credit card usage is going up. Now, why is that? Is that because of inflation, or is that because of COVID and people are just done and tired of COVID and they want to go out and have fun anyway? We don't know. But what we do know is that credit card usage is up. So, and we know that it's painful right now for the average individual. We know that inflation affects employment. Again, every time that the Fed's raised the Fed funds rate and it's gone down, we've had recessions and we've had employment gaps. So as a recession hits, boom, we have an employment gap. Recession hits, boom, we have an employment gap. Recession hits, boom, employment gap. We consistently have that. Now, if you don't think that it's affected employment, right here, Twitter cutting 50% of its workforce, which it's been more now with Elon Musk purchasing. Facebook cutting 13%, they've cut more. Snap cutting 20%. We go down the list of people that have been cutting their workforces. You look at lenders. There's been a lot of lenders that have really cut their workforces and slashed their workforces. So inflation has a major impact upon housing. Big key is that inflation leads to recession. It always happens. During a recession, every recession since we've had since 1980, interest rates have gone down, every single one. And November the 10th was a very telling time. November the 10th showed right here, this was the big candlestick here, the big green candlestick. That was the day of our CPI report that came out that showed that inflation may have ticked down now. It may have ticked down. It's important to know. May have ticked down. Now, again, we're looking back at lagging indicators, we're looking back. So just a year ago, so October to October, November the 10th that came out, October to October, October of last year, we had higher inflation. And so as we had higher inflation than we had this year, then the market really loved that. They really loved that information. So why is all of this important? This is all important as you're building the case with a client. And how can you teach this to a client? Is ultimately, as you go through, you define inflation for them. And we're all in this together, right? We know that as inflation goes up, as the Fed does their job, they raise the Fed funds rate, they go too far. The Fed, they're not on track. In fact, they even said that they weren't keeping their eye on their ball. They really didn't know how to really combat inflation yet. They really didn't raise the Fed funds rate as quickly as they should have. They go too far because they're looking at lagging indicators. And as they go too far, then for America, it starts to have problems with savings. Interest rates continually climb. Credit card usage then is now triggered. So savings goes down, credit card usage goes up, employment starts to rise, unemployment starts to rise, which is what it's doing right now. That all leads to a recession. As it all leads to a recession, what happens during a recession? Interest rates start to go down. So as you're building this case with the client, you're sharing all these things with them, and we can start to go down and we can say, okay, the Fed's raised the Fed funds rate, savings has gone down, check. Credit card usage has gone up, check. Unemployment has started to trickle up, check. That all leads to a recession. And as interest rates go down in a recession, what happens? The laws of supply and demand start to come back into play, right? As the laws of supply and demand start to come back into play, who comes back in the market as interest rates go down? How many of us have had clients as of late that have said, I'm going to pause. I want to buy a house right now because of interest rates. They haven't said, I want to pause because I'm going to buy a house because they're too expensive. They're saying, I got to pause because interest rates are too high. My payment's too high. And so that's really the main reason why they're pausing right now. Now, again, as I've said, I think this is the perfect storm right now, and I don't think we have very much longer, because all these other things have happened, and that means the recession is here. We are most likely in a recession right now. It's just the definition of a recession, as per our politicians, has changed. So they keep changing the definition of a recession. But ultimately, if we had the old definition of a recession, then that would have been stated that we're in a recession. I think truly we're in a recession right now. If not, the last leading indicator is employment. And employment just started ticking up. And typically within around 3 months of that lagging indicator of employment, that's when a recession is announced. Now, why is that key? Again, because interest rates come down during a recession. As interest rates come down during a recession, what happens? Well, we've got clients that are going to start to flood the market again. So if your clients want to flood the market again with everybody else, then awesome. Otherwise, laws of supply and demand, right now, it's a great time to buy as you share all this with a client. Now, a client can still say, oh, hey, I don't know. Maybe interest rates are going to come down, but I just don't know about housing. I think there's a bubble. Well, I love when people talk about a bubble, because I talk about two things. I show them one slide that I've kind of beat to death with you guys, which is the slide that talks about the media is out of touch. And so, but I wanted to bring something new to you guys and new as to what I'm talking to clients about. So the FHFA, so who are they and why are they important? We all heard about this. What was it, last week, week before last? I think it was last week. It was all the rage on social media. The FHFA, the Federal Housing Finance Administration. What did they do? They raised the conforming loan limits up to 726,200. Now, why is that important? And I always look back at these and I'm saying, okay, what's really the underlying message here? What is something that we can learn from this? It's awesome they raised it from 647,200 to 726,200. But what's that really telling us? Now, let's look at who the FHFA is. The Federal Housing Finance Agency was established by the Housing and Economic Recovery Act of 2008 and is responsible for the effective supervision, regulation, and housing mission oversight of the Federal National Mortgage Association, Fannie Mae, the Federal Home Loan Mortgage Corporation, Freddie Mac, and the Federal Home Loan Bank System, which includes the 11 federal home loan banks and the Office of Finance. The agency's mission is to ensure that Fannie Mae and Freddie Mac and the banks fulfill their mission by operating in a safe and sound manner to serve as a reliable source of liquidity and funding for housing finance and community investment. Let's go back. The FHFA, their job is to fulfill the mission by operating in a safe and sound manner. Let's look back when they were created, 2008, when all heck broke loose, right, in the market. So they're created in 2008. We know that. They're the oversight committee for Fannie Mae and Freddie Mac. We know that. Their mission by operating in a safe and sound manner. They're pretty important. That's how I look at it. They're pretty darn important. Now, they raised, let's look at what they did. Again, instead of, they didn't say anything really, but they did something important. So they raised the conforming loan limit from 647,200 to 726,200. That's a 12.21% increase. Let's look at the increases that they've had since 2009. So we look at this, they were just deadlocked for a long time till 2006, 2017, where then they started increasing the conforming loan limit, and they've increased it even more. When we look at the trajectory that they've increased here, I mean, look at this. Since 2016, and then 2017 and 2018, they started increasing. So if they are oversight for Fannie Mae and Freddie Mac, which is the main purchaser of securitized mortgages, and their mission is to fulfill the mission by operating in a safe and sound manner, and they are increasing the conforming loan limits this much by 12.21% this last year, or this upcoming year, 12.21%. Would it be safe to say that they believe in housing? I think so. I think so. Now, the story doesn't end there. How much do they believe in housing? In 2021, they increased the loan limits by 18%, over 18%. So the big story is that they believe in housing so much, and they believe that the whole case of a bubble is so overblown that they have increased the conforming loan limits by 30% in the last 2 years. That is massive. So if they are the ones that oversee this, and they are the ones that look at Fannie Mae and Freddie Mac and help Fannie Mae and Freddie Mac run in a safe manner. And we don't want 2008 to ever happen again. Now, the reality is that 2008 was a 40-year market. We will have that market again, I guarantee you. And it will happen in 40 years from 2008. We have it every 40 years. So there's nothing we can do about it. It's statistically proven. We will have that market again in 40 years. But the thing is that there's a lot that happens between that period of time. Our values rise consistently and that. So as we go back, the Fed raises the Fed funds rate to slow the economy down. Check, they've done that. They've been slowing it down. We know instead of pausing, like they really should, they're going to go too far. We know that savings has gone down. Check. We know that credit card usage is going up. Check. Those are all signs of a recession coming. We know that employment has started to tick up. Check. Again, sign of recession. That means we're leading to a recession, which means we're leading to lower interest rates. Fannie Mae or FHFA believes in housing, very, very much so, that they've raised the conforming loan limits by 30% in 2 years. Massive. So in the absence of trustworthy, up-to-date information, real estate decisions are increasingly being driven by fear, uncertainty, and doubt. With this slide deck, do you feel that you can help clients get off of fear, uncertainty, and doubt? And I'm going to say, I'm here to help if you can't. Have your clients meet with me and I will get them over fear and uncertainty and doubt. I will statistically prove to them that now's the time to buy. Now is the time to buy. These decisions can be hugely consequential for consumers and businesses. We don't want any of our clients saying, I wish I had bought a house last year. You know, just like 2008, in 2009 and 2010, people were starting to say, oh, I wish I'd bought a house. 2012, I wish I'd bought a house in 2008. Most of the time, it's always back at that point. They're always looking back and saying, I wish. Let's not have any of our clients say that. So, and Margaret, I'll get to your question here at the end. If you want, you can put it in the chat or in the question and answer section. For those bearish folks eagerly waiting for the home price crash, you'll have to keep waiting. And this is a deputy chief economist for Redfin. So, as much as demand is pulling back, supply is as well reducing downward pressure on prices in the short run. The key is this is in the short run. So we're seeing right now, again, people are able to get to buy houses, you know, and they're able to get some closing costs where just a year ago they couldn't do that. Massive. So from there, we know that a recession doesn't equal a housing crash. We know that 2008 we had values that went down, but again, that's a 40-year market cycle. And in 1991 was the only other time. So really, values increased during a recession. This is a deputy chief economist as well. If you can find a house that meets your payment, your financial expectations for a monthly payment, and is a good time for you to buy, then do that. And if you wait for prices to fall, but they never do, you may discover the hard way that the house that you found a year ago that you really loved, that you could afford, but you passed up on, is more expensive next year. That will happen. The desire for home ownership is strong. Many prospective buyers are waiting for the volatility in mortgage rates to subside. That's a mistake, as well as for a clear picture of the economic outlook. The laws of supply and demand, guys, this is it right here. And this is when I share this with clients, they start to really understand the laws of supply and demand. Freddie Mac has already said that we're down 3.8 million houses across the US. We're only making 1.3 to 1.4 million homes a year. Only. That's a lot. However, 1 million of them are single family, 300,000 are multifamily. There's about 100,000 homes that are destroyed every year. Total supply, that means we're around 1.2 to 1.3 million homes that we're entering into the market every year. However, we're creating 1.4 million households right now. That's going to happen for the next 4 to 5 years, guys. Those are the millennial households. The average first-time home buyer is 31 to 33 years old. Those are millennials, and they are buying homes in groves right now. A parent deficit is around 100 to 200,000 homes per year, which means this number is going to continually rise. So the laws of supply and demand. So, so Mark, no. So when is a bad time to buy? Well, a bad time to buy would be if you know that values are going down. However, values aren't going to go down. So we all need shelter. We all need housing. And so if we can find the house that we like, which right now is the time that we can find a house that we really like, then really it's a great time to buy. You can negotiate on a house that you like a little bit more, and you're able to purchase that home. So values are going to consistently rise. It looks like with November 10th, that data that came out with the CPI report, it looks like that we've topped inflation. So what's going to happen now is that, remember, the Fed goes too far. They're going to hike again here in a couple of days. They're going to hike again probably in January. They're not going to pause. They're going to hike and hike and hike. As they hike, they're going to slow the economy down so much that then they'll pause, and then they have to chase the Fed funds rate down with inflation. As they do that, then interest rates are going to fall because there's going to be uncertainty in the markets. People are going to take their money out of the stock market, put it in the bond market for safe returns. Now, as they do that, then again, interest rates are going to fall. As they fall, we're looking at probably 5% interest rates in the first quarter of next year. It could happen this month, but really it's probably going to be in the first quarter of next year. And potentially, if the Fed waits too long, we could go into a deflationary market where interest rates could be even much lower than that. They could get back down in that 2% range or so. So when is a bad time to buy? I don't know if there really ever is a bad time to buy, because we need shelter. We all need that. So either rent or you buy. But if you're looking at housing as a longer term investment, then it's a great time to buy. Now let's look at housing, or let's look at the 2-1 buy down. Now, who all here has heard of the 2-1 buy down loan? So I don't know if there's anybody here that has not heard of the 2-1 buy down loan. So it simply is where you have an interest rate of, say, 6.625%. So your first year, you're going to pay 4.625, then you're going to pay 5.625, then you're going to pay 6.625 going forward. Now, if you believe that interest rates are going to go down and that you're going to refinance most likely, then a 2-1 buy down could be the right way to go. This was just as of rates yesterday. So when I priced out a loan at 600,000. Now we could buy down the interest rate. It would cost 3 points to do that, down to 5.625. Or we could take that 3 points and do a 2-1 buy down and start out at 4.625. So which way is the right way to go? It saves the client $332 a month. So if a client is coming in and saying, I just can't make that payment. I'm qualified at that payment, but I just can't make that payment. I can't emotionally get over that. Then a 2-1 buy down might be the holy grail of loans. It all is about suitability for the client, guys. It's all about what's right for the client. Now, here's the thing that maybe nobody's shared with you about a 2-1 buy down. So let's just run through it. Here's the payment breakdown. So you're looking at $35.62 on a $600,000 loan at 10% down, or you're looking at $38.94. Now, this is with mortgage insurance. This is with the taxes and the homeowner's insurance. And here's what happens. So there's a subsidy that happens on the first couple of years. Rocket Mortgage makes it sound like they're paying the subsidy. No, it's really the seller that's paying the subsidy. And so, but you've got a subsidy that's happening for the first 12 months of 681 that's dropping that payment down to 3583. You've got a subsidy that's happening 13 through 24 months that's bringing that payment down. At that point, it goes to 3915. But what's cool about that subsidy is if interest rates turn the corner here in the next 6 months, and if we refinance in the next 6 months, the seller contributed $12,300 to buy the interest rate down or to do a 2-1 buy down. So they take the 12.3. If you add up the subsidies, these subsidies here, 681 and 349 for 12 months each, that equals the 12.3. So let's say they're only in the loan for 6 months and then they're refinanced at that point. They get the remainder of that subsidy. The buyer gets the remainder of that subsidy. That's why this loan could be an awesome, awesome loan for the majority of clients, because we will be refinancing in the next 6 to 18 months. Now, where it's may not be the best thing is if we're refinancing out after that 24 months, or if we're refinancing closer to that 24 months. So it depends upon when the market turns, whether this is the holy grail or not, whether this is an awesome loan for a client. Because again, let's say that we refinance them on month 13. Well, at that point, the buyer will get $319.40 times 12 months. They will get a check for $4,189 of that subsidy that was not paid. So what happens is that this 12.3 that the seller is paying, really to do that temporary buy down, to start the rate down at the 4.625, then go to 5.625, then go to 6.625, that 12.3 that the seller is paying, they ultimately, that will go to the buyer when they go to refinance of whatever subsidy is left. Whoops. Now, an easier way to look at it is, instead of the 12.3, do we just buy the client's interest rate down to 5.625? It would cost roughly $15,660. So do we have the seller pay that? It's an extra $3,000, $3,300. Do we have the clients do that? Does that make sense? So understand that really, I'm hearing so much about the 2-1 buy downs. Heard about it a lot over the last month or so, 2 months. Everybody's talking about it, but nobody really, I'm finding that a lot of people don't really understand it. It can be a good loan, but it might not be the right loan for all clients. So it's all about suitability, and it's all about working with a lender that is going to talk to the client about all of this information so the client understands the market that they're in and helps the client determine what the right loan is for them and for the seller. Last that I want to just touch upon real quick. I'm starting to see this, and I believe that it's deceitful. And when I see deceit, I want to call it out. So here it is. You do a loan with me, and I will refinance you over the next 6 months, year, at no cost to you. To me, when I hear that, that grates on me, because I understand, just like when we raise the minimum wage limits, businesses still make the same amount of money that they used to make. I mean, a Big Mac used to cost $4, $5 to get a Big Mac meal, and now it's $8, $9 or whatever. As the wage increases, the restaurants raise their prices. It's very simple, laws of supply and demand. So lenders are going to make the same amount of money that they've always made. So how do they're not just going to do a free refinance for you. I mean, the average loan costs over $8,000 to procure. By the time that you pay all the employment costs and compliance costs and I mean, lease and all that stuff for all the employees it takes to create a mortgage, It costs on average right now around $8,000 per loan. So you mean to tell me that a lender is not going to charge that $8,000 to refinance? I call BS. So Napoleon Hill said, the one who tries to get something for nothing generally winds up getting nothing for something. So these free refinances, or we're going to pay massive closing costs. If you work with us, we're going to pay massive closing costs to have you work with us. Again, guys, doesn't work that way. Lenders are going to make the money that they're going to make. So here's the secret. Here is behind the veil, guys. This is how a lender pays for it. And I don't think it's right. I think clients need to know this. So what is a no-cost refinance? A no-cost refinance is an option where the lender pays your closing costs instead of having to pay themselves, or instead of the client paying them themselves. But your mortgage rate will be higher as a result. So remember that when we get rates, we get a rate stack. And that rate stack will go from 5.25% to 8%. So if the going rate at the par rate, where there's no cost, is at 7%, let's just say, but yet I'm doing a no cost refinance, your rate's probably going to be 7.5 to 7.625. If I'm paying your closing, if I'm paying a big portion of your closing costs, then I'm probably going to bake it in the rate. Let's just be truthful about this, guys. And so, so that happens, and the client's none the wiser. They don't see it. It's just, oh, wow, the lender was so nice. They paid a bunch of my closing costs. That isn't what happens. There is nothing for free. So please work with people that don't promise big closing costs, because your client's going to get the best deal at that point, the best overall loan and that, and work with people that give advice. And again, you know, at this point, we've got a couple questions here that I'll answer, but please, you know, Fidelity has worked hard on bring this back here. So Fidelity, you know, Tracy and I have worked hard over the last several years on offering these classes, making sure that you get your CE credits. Please, anybody that is looking at a title company, please work with Fidelity. They are truly awesome. Again, I have the best experiences when working with Fidelity, and you know, and I know that my client is always going to be taken care of. For my team and I, we'd absolutely love to work with you on your next transaction. Let me show you what we can do for you. Let my team and I show you what we can do for you. Your clients are going to be super happy. They're going to get the education and the training that they need to be able to know what the right decision is. Because right now I'm finding a lot of lenders are not sharing this information with clients. And I think that they're doing a disservice for the client. We had a client not too long ago that came to us that was working with another lender here in town. And that client came and they said, you know, hey, look, we want this rate. Here's the sheets that I got from the other lender. And when I looked at them, I saw that it was the lowest rate they wanted. And I said, well, why do you want the lowest rate? And they said, well, ultimately, because isn't that what you do? You get the lowest rate, right? Strategy is much more important than rate in this market, guys. Strategy is much more important than rate. And so with that strategy, the rate that, yeah, she was getting a great rate, but it was costing her $8,000. So what we ended up doing was we did a higher interest rate loan to where they weren't paying the discount for points and that for the rate, because we knew that this loan is going to be short term. We know that we're going to be refinancing this loan in the next 6 to 18 months. So we saved the client $8,000. Yes, we drove her payment up by $270 a month and they qualified, but that made more sense. It can take the market 4 years to recover from the money that they saved. And so then she starts to lose money after 4 years. But in that meantime, if we refinance in the next 18 months, we save that client money. It's the consultative approach that is so, so, so important. And I asked if this lender had gone over any of this information with her client, with her, and she said no. So I know that a lot of lenders aren't doing that. We have always educated, we've always helped. So, so send your next transaction to Tracy, please, and then give us a shot. Give us an opportunity, guys. Let me just see your last question. Does it matter if you're going FHA or conventional 2-1 buy down? No, both of them have a 2-1 buy down. Very informative class. Thank you. So, yeah. So,
Margaret had a question. She wanted to know if you had a particular site that you use for your information.
No, I get my information from a lot of different sources. I get, one of my economists is Dan Raworth, which is a subscription that I pay for. And then I also get a lot of my information from Barry Habib, which is MBS Highway. And
I love him.
Yeah. So another subscription that I pay for. I honestly do not get my information from the news. If the news says something, I'm going to go the other way.
Yeah.
If they say it's a bubble, I know there's no bubble. If they say now's the time to buy, then I'm saying, oh crap, what did I miss?
Hold on. Okay. Okay, well, awesome. Another great class. I just have been over here punching in everybody, getting their CEs ready to go out. So as soon as I get the recording from Walt and see that you guys have all been on there for the majority of the class, then those will go out. So,
yep.
Okay.
And I'll send the slides out to you guys as well. So I'll send it in. And if you guys want the actual PowerPoint, just email me direct. It's W Schultz, SCHULZ. So WSCHULZ at canopymortgage.com. Email me direct, and then I'll send you the actual the PowerPoint. For me to be able to do it through my software, I can send you a printout, but I'm not able to get it out to you. So, but if you want it directly, then just let me know and I'll send it directly to you.
Cool. All right. Okay. Thanks again,
Thanks,
Walt.
guys. Have a great day. Bye.
Bye, everybody.